Hi everyone, today I'm going to talk about the 5 stocks that I bought last week, not the week that's just gone. I'm going to go through these 5 companies and just talk about them for a couple of minutes, why I'm buying them companies. They're all stocks that I own and they're a bit of a mixture of stocks as well on that week. One stock in particular, I actually didn't have plans to buy it. It's just that it dropped so much after earnings and I thought the earnings report were really strong. So that's why it was 5 stocks in the end. But yeah, I'll just talk about them for a minute or two. It won't be a massive deep dive into them. I do have full deep dive videos about, I think, all 5 of these stocks on the channel somewhere. So if you do want a bit more information, do go check that one out. And as always, I just thought I'd update you guys so you know what I'm buying and selling and keeping that transparency up, especially in a time where we're in such a big bear market, in a stock market crash. I think it's more important than ever that I just keep that transparency up so you guys know the moves that I'm making in the stock market. So we'll take a look. Now, if you do want to know what I'm buying and selling in real time, Patreon is the place to be. I post live buy and sell alerts in there, as well as a Discord with 600 members. And I also post 2 exclusive videos a week on there. One of them was my UK portfolio last week, and I will bring out a review of earnings from last week of the companies I own and some companies that I don't own. I've currently got, I think, 3 more conference calls to go through this weekend, and I will have that video up on Patreon for you guys that are on there, and we'll take a look at these 4 stocks, or 5 stocks should I say. This was the one that actually snuck in that I didn't have actually plans to buy, but it was DraftKings. So I didn't have any plans to buy DraftKings, but they reported earnings on that week, on that Friday. And yeah, I committed to the 4 stocks that I was going to buy. This one came and reported earnings. The stock was up 10%. Looked at the numbers, thought fair enough. You know, the stock really good earnings. It should be up 10%, probably even 20%. But obviously we're in a bear market, so it never works as much as easy as what you say there. But it was up 10%, and then within that day, it actually went down 8% on the day that it reported earnings. And you'll be able to see that drop just there. So yeah, it was a complete reversal from 10% up to 8% down, nearly 18% swing on the day of earnings. And yeah, I thought, you know what, I'm going to have to buy some shares after the earnings report, especially DraftKings now down on this kind of $12 mark, 5 billion market cap. And this year, my expectations is DraftKings puts in around about 2.1 to 2.3 billion in revenue. So to see a company that's going to be growing at 50+% revenue, that's really getting on that path to profitability now, and it's valued at like 2 times sales, it's just unbelievable. You know, it's scary how low this is being valued right now. Like for me, this is the stock that I've seen since, you know, Square, since Shopify, that I just see so much potential in. Like this is, in my opinion, going to be a future 100 billion market cap. So if I can keep accumulating shares down here, I will do it on DraftKings. Now, I did do a full deep dive into their earnings on the channel, so if you do want more information, go watch that earnings out. But yeah, they brought out the numbers. The numbers were fantastic. Revenue growth of 33%. Their average revenue per month for user was up massively as well. And as well as that, there was a massive hike up in outlook, which when you look at what a lot of companies are doing right now, especially growth stocks, a lot of growth stocks are hiking down the profitability, hiking down the revenue. What did DraftKings come out and do? They raised up their revenue guidance to 1.8 to 2 billion. I still think it's going to be more than that. I still think they're going to be 2.1 to 2.3 billion, which is a year-to-year growth of 49% to 56%, which is unbelievable. They also raised the adjusted EBITDA loss from 825 to 925. To 760 to 840 million. So I think the stock last time got punished 20% on earnings because they decreased the amount of losses, or increased it, should I say. They were going to lose more money, and now they move it back in the other direction and they got no reward for it. It was just absolutely stupid, but that's the bear market that we're in. So yeah, hiking up revenue, losing less money as well. And also they announced the acquisition of GNOG at last, so this is going to be massive this year. This is going to help up with the advertising because they'll be able to advertise in a lot of the golden nugget upsides of it. They get Tillman Ferretta coming onto the board, the iGaming side of it. Probably the weak part of the iGaming, or the weak point of DraftKings is the iGaming. So obviously having GNOG should really help that as well. So this is a really good acquisition that they've made recently. And the great thing about DraftKings is that as more and more states allow online sports betting, online gambling, the revenue is just going to grow and grow. But the thing is states that even are the more mature states, you know, probably the first state that we're in, New Jersey, which was in 2018, should I say, sorry. Even the states that are the mature states, these mature states still grow at unbelievable rates. I mean, look at this, 54 million, 244 million, 360 million, 740 million. So even though this is getting to 4 years in now, they're still growing at like 100% rates. These are the mature states, and the thing is, these mature states then also convert to profitability. And you'll see here the profitability path is that New Jersey launched in 2018. It takes around 2 to 3 years for a lot of these states to come profitable. What happens in 2 years' time? New Jersey comes profitable. And then you look at the 2019, same again, 2 to 3 years' time, the state comes profitable. You look at the new states that came online in 2020, we're expecting, well, one of them is already profitable. We're expecting 2 of them as well to come profitable once again. And you can see this is just the path to profitability. It's proven that these states come profitable in 2 to 3 years' time. Sure, there's a few costs to launch these states, but you get the payback in 2 to 3 years' time. The model is proven here. And the thing as well is, if you do look, the path to profitability is starting to get a lot quicker. You know, you're getting states that are starting to come profitable with nearly a year's time, which is fantastic. And when you look at something like in New Jersey, the most state that's been obviously running longest, look at the amount of contribution profit that they bring in. So you can see here that it was a loss of 10 million, a loss of 5 million, and then you can see here that that actually turned into 8 million, and then in 2021, look at the amount of contribution profit that's bringing in now. 28%, 68 million. And this is the crazy thing is like, look at the thing is this is what people don't even factor in, is these mature states that bring in really good amounts of profit in. Look at the growth rate. Like, they're not even growing like 10%. These are still states that grow at mass amounts of rates, which is the scary thing. So even when this company comes mature, it's still going to be commanding very good amounts of growth. So this is why, in my opinion, this has so much potential going forward. So yeah, number one is DraftKings, and I'm sure you're all very much aware of how bullish I am on this company. I think the path to this being a 100 billion company is very much on, and I'm excited. It's the investment I get most excited about, and I think that shows with how much I do buy the shares in it. Next up, a bit more of a stable company, which is Google. So I did buy some more shares in Google, trying to build that position size up. It's my newest position in my portfolio. I've only just started buying this one 2 weeks ago. I did buy a couple more shares in this one to try and just start building that position up a little bit. I'm kind of worried that Google won't be down at these sort of prices for long, but hopefully it is, and I can build up a decent position. It's a 1.5 trillion market cap, so it's a massive company. This is the sort of company that, you'll never see a 5x, 10x from. It's a company that will, in my opinion, probably double up in the next 5 years. Potentially, you might get a 200% return from, but yeah, I would say more safe to go around the double up. When you look at Google and the brands they have, there's so many different incomes that are coming in here. They're so strong. There's so many brands that they have that they've created and will continue to create. I mean, when you talk about moats, this is the moat. Whatever you want to look at, there's so many good brands in here. And the Q1 in my opinion was actually quite strong. Like, operating income was still pretty good. You look at the revenue growth was still fantastic, even considering YouTube had a little bit of a slower quarter. I mean, you're still growing at 23% here, and operating income still jumped up 22%. So yeah, I mean, the company is still moving, having a few little short-term issues, but when you look at the long-term picture, it's still all moving in the right direction with Google. And when you think about the brands you're getting, it's really good. You look at the profit they do, and we'll go back to increasing that profit. You're talking 74 billion in profit nearly every year, which is just insane. And they'll continue to grow revenue at a good double-digit rate as well. Financial health-wise, they're sitting on a lot of cash there. Obviously, a lot of cash will lead to share buybacks. So that will increase my ownership in the company. 134 billion in cash, which is amazing. So yeah, I think this is one of the strongest companies with one of the biggest moats. Absolute, great balance sheet, a profit beast, will buy back shares. And in my opinion, Google, with, like we said, a lot of these brands that it does have going forward, with it being YouTube side of it or even the cloud side of it, they'll continue to grow very well going forward. So yeah, I think you're getting a good revenue company here, good profit company, amazing balance sheet, one of the best moats out there. I think this is an easy 2x in the next 5 years, just somewhere safe really to put my money in, and I think it'll be one of the safest stocks that I own that will bring in a good return. So yeah, I did buy some more shares in Google, and just to let you know, Simple Wall Street at the moment, there's a link in the description. If you do join through that link, you do get a 14-day free trial with this platform, and as well as that, on the 5th day, they will send you a discount code of 30% off your yearly plan as well. So yeah, you get a 14-day free trial, and you'll also get a discount code on the 5th day as well. So if you do want to give that a go, link is in the description. So that is the safe stock of number 2. Next up, a little bit more of a risky one, but I think this one here is a stock that, I mean, even at a 5x return, I would be disappointed with this stock. I think that this has the potential to be one of my biggest or best returning stocks in the next 5 years, which is Hims and Hers. So this came through a SPAC. It went a little bit crazy, as a lot of SPACs did in February time, and then it went from $23 and just started downtrending. Now when it got around to about this $8, $7 mark is when I got interested in this business, and I went, you know what, I'm gonna have to pick some shares in it. Now unfortunately since then, the whole growth stock and bear market has carried on, and it has gone down a fair bit, and I do continue to average down on this position, and I do think it's very unfair that it is down now at this sort of valuation. It's a 710 million company market cap wise. It is founder led by Andrew Dunham, who does have a massive stake in the company, and it is a telehealth company that is currently now growing faster than during CV and pre-CV. So this company is just going strength to strength, and it is founded in November 2017, which is a very, very new company. Now they did report earnings out. Once again, I did a full video on their earnings. The earnings were unbelievable, best of earnings season that I've seen so far. So they did make a slight loss, but revenue was 101 million, which was a 93% year over year, and they hiked their revenue guidance up to 410 million to 425 million. And considering this company is 710 million, and it's going to put in 410 million to 425 million, unbelievable. And it's growing at 100% nearly on year over year, and it's not even losing that much money. The losses in the recent quarter shrunk hugely, and this company is now moving on a path to profitability with massive amounts of revenue growth and hiking the guidance up. And this is really impressive when once again you see companies downgrading their guidance. A company like Teladoc, something very similar, that one's struggling, and you look at Hims and Hers, which is just absolutely bossing it right now. And like I said, this company as well has fantastic growth, and it's on the way to path to profitability now. When you look at the company, the gross margins is 74%. They make gross profit of 74 million. And if they wanted to make profit, they could do, but they're really investing into the company. If they didn't want to do that, obviously they might not grow as much, but they're taking market share, and that will lead to more profit further down the line. But look here, they are expanding a lot into the company right now. But yeah, the losses are really coming down, and if they wanted to, this could be a profitable company, but they're making sure they are taking market share at the moment. But if the company carries on at this rate right here, we are going to be talking about Hims and Hers potentially sneaking in a profit very, very soon. So this is very exciting from this company. I will keep it nice and brief, because like I said, I did a full video on it like 2 days ago. But yeah, this is a company that is firing on all cylinders and at such a cheap valuation. Next up is Pinterest. So I thought I'll buy some more shares at Pinterest at $21-ish. Looking at the company now, it's basically now down once again back to the prices that it IPO'd at. It's trading down at 40 times earnings, and it's a 14 billion market cap. The numbers they reported was pretty strong. The EPS is starting to move very, very much into a profitability rate. They're still growing at decent margins, and that's on very hard comps. The positive news is they do expect user growth to start coming back in the right direction later this year, which would obviously be positive. More users obviously means you have more people to market to or advertise to. The growth story of Pinterest is that they are now starting to monetize a lot of their Europe growth or rest of the world growth, because that's where actually a lot of this platform is popular. It's in Europe, it's in the rest of the world. And that is very clear when you look at the average revenue per user. You'll be able to see that global is 28% and US and Canada is 31%, but you'll see here Europe is where it's growing the fastest, is 40%, or faster than US and Canada, which is what they really need to hike up. And the rest of the world, which they've hardly started to monetize to, but they are starting a little bit now, 164% growth. So this company is still growing at massive amounts. This is very much still early on in its advertising stage, so this will carry on growing at massive rates, and this is where the profit and revenue growth will be in the next few years, and the story there is still continuing, which is great. And when you look at the company, you can see that they have very much moved that revenue in the right direction, and the profit is really starting to come in with this company. Apart from a few investments that they are going to make this year, that we're going to see that profitability really ramp up as they advertise more and more, especially in Europe and in the rest of the world. Financial health wise, they're a very clean business. There's no debt on that balance sheet. They sit on 2.7 billion in cash, which is very healthy. And once again, it's a founder-led company with quite a bit of a big ownership. So yeah, Pinterest is going through a few headwinds with user growth, which looks like it could sort itself out in coming few quarters. But the main story here, which is, can they carry on making more profit and revenue from maxing their advertising to the users, very much continues, and that's shown in the financials. So yeah, I think that Pinterest has had a massive unfair drop here, and I'm buying some more shares in this one. And the last one is Shopify. So I cannot believe that I'm picking up some shares at Shopify at $400 at a 50 billion market cap. This is the king of the e-commerce businesses, really. If you are setting up an e-commerce business, even if you're a small company, even if you're a big company, you're going to go to Shopify to do that. The stock is being hammered though. It's gone from $1,600 to $400, and it's now down 75%, and is way below where it was pre-CV times, which is just unbelievable to think about the progress this company has made in the last 2 years. An example of that would be that they were doing 1.5 billion at the back end of 2019, and if we look at what they've just done now, they've done 4.6 billion. So the revenue growth has over doubled in the last 2 years, and there's hardly any reflection in that from the share price performance at all. The earnings themselves weren't too bad. The company is currently going off some pretty hard, tough comps here, but still growing very much in the right direction, and will continue to grow very much in the right direction once it gets past a lot of these hard comps it's going through, and we should go back to 30+% revenue growth. And once you take again the expansion of this company to carry on expanding out of what it's doing, this company is once again a very profitable company. You can see here they do make 637 million in profit or gross profit, and they do reinvest quite heavily into the business. So once you start cutting these back and they stop expanding, this is going to be bringing in massive amounts of revenue growth. And what this business does is it's very sticky, this platform. If a business comes in to use Shopify as their e-commerce platform, it's very hard for them to move away. They have built up, and this is why they reinvest into the business, they built up a platform here that offers so much to businesses that come on to use it, from payments to capital to marketing to analytics, apps, inventory fulfillment, which is one of the biggest expenses they're using at the moment, order management, shipping. There's so many different incomes that they're building up through helping these businesses grow, and they obviously make income themselves. And from that point of view, this is still going to be very much the go-to platform for e-commerce, and in the next 5 years, businesses that are on the platform will continue to use it, and new businesses that come to the platform will stay with it because of how beneficial it is to them businesses that want to get online. And now the business is left at very cheap valuations, a lot cheaper than what it has been historically, from total enterprise value to revenue to total enterprise value to EBITDA. It's looking very cheap at these sort of valuations. So for me, Shopify is one of the stocks at the moment that is very attractive that has been sold off. So those are the 5 stocks that I bought. Hope you enjoyed it. Let me know what you're buying in the comment section as well. If you could, hit the like button. If you're new, subscribe, and I'll see you on the next video.